Hello, and welcome to this first video on TJA economics. We're going to do something very simple, one of the building blocks of modern economics and one you're likely to come across in A-level economics and GCSE economics. We're going to be looking at supply and demand diagrams. And what you're probably used to seeing is a diagram that looks something like this. You know, you've got your axes, your price, your quantity, your supply, your demand. But what people often don't know is how the curves work, what the axes actually recommend. And so when you have a demand curve moving like this, a lot of people struggle with what that actually means. And so what we're going to do today, we're going to be looking firstly at how supply curves work. We're going to be looking at, supply curves, supply schedules, things like that. We're then going to be looking at demand curves, etc. And then we're going to sort of put it together, look at how they work together, and maybe do an example or two. So, a supply curve shows us the relationship between how much something costs and how much producers want to sell it. So let's take something like this Adidas ball, the Euros. It shows us the relationship between the price that the firm can sell it for and how much they want to sell. So for example, we could put different price levels for this football into the price column and we could say how much they want to sell. So for example, if the price is £10, they then want to sell 100 of these footballs. And if the price goes up, the firm wants to sell more of these footballs. I think that should be quite obvious. But the question we have to ask then is, why is that the case? Why is it that when price goes up, firms want to sell more? Well, it's because of this, the profit incentive. If prices are higher, firms can make more money, so want to supply more. And that's why the supply curve is upwards. When the price goes up, the quantity goes up. And that is something that I think we can understand. And so we can take our supply schedule and our football, and we can look at a sort of diagram. And so, for example, we've got our axes here, we've got price, we've got quantity, and we can sort of take our values from the previous table and put it onto a graph. And what we're going to see is that as the price increases, so will the amount that the firms want to supply. Again, that should be quite a simple idea, If a firm can make more money, they're going to want to supply more good. In this case, if Adidas can make more money, Adidas are going to want to supply more footballs. And so, like we say, as the price goes up, they'll sell more. For example, if the price is £10 per football, Adidas will sell 100. If the price is £30 per football, Adidas will sell 300. And if the price is £50, then Adidas will try and sell 500. So let's move on to demand then. So a demand curve is kind of the other side of this transaction. A demand curve shows us the relationship between how much a good costs and how much we as consumers want to buy of that good. And so we can put it in a table much like before, but let's do something different this time. Let's do a Yorkie, for example. And as we can see, this is the example I use in all of my classes. If you go into a corner shop and the price of a Yorkie were 30p, let's say, you might buy a couple of them. That's quite cheap for a Yorkie. And so you might buy more than you normally would. If the price goes up to 50p, 60p, you're going to buy fewer and fewer Yorkies. And if a Yorkie ends up costing £1, you're not really going to buy a Yorkie for £1 because it's quite expensive. And so it's kind of the reverse of the supply. With demand, as price goes up, quantity demanded falls. And that's simple. Again, we as consumers can recognise that. If something costs more, we're going to buy less of it. Again, we can show this graphically. We can take our axes, much like we did with supply, and instead make a graph for demand. And so again, we'll take our Yorkie, we'll take our prices for those Yorkies, and again, as you can see, when the price of a Yorkie goes up, we buy less. So if the Yorkie costs £1, maybe we don't buy much at all, but if the Yorkie costs 20p or 30p, we actually buy quite a bit. And so supply and demand work in opposite ways, if you want to think of that. And so we can put this together. We can take our supply curve and our demand curve and we can put it together. Like that diagram I showed you at the start of the video, we can put it together. And here we have our supply and demand diagram. And you'll see in the middle where they cross, there's where the middle of the X is, we call that equilibrium. We call that equilibrium in Latin. It means balance, because supply and demand are balanced. At that price, supply and demand are the same, and that's brilliant. It means the market is efficient. But is that always the case? Let's look. If the price is higher than the equilibrium price, why is that a problem? Well, let's look. If the price is higher, it means that consumers, you and I, we're not going to demand much. Our demand is going to fall. However, because the price is higher, as we saw earlier, firms are going to want to supply more. And so there's going to be too much supply, not enough demand. And so that's a problem because that's sort of inefficiency. There's too much being produced. What about if the price is too low? In that case, there's going to be too much demand, not enough supply. Think of this, at the start of the COVID-19 pandemic, for example, at the lockdown, there were queues outside of supermarkets. The shelves were empty. That's because the prices were too low, arguably. There was far too much demand for these goods and services. Firms couldn't supply enough, and so there was a shortage. There wasn't enough. Arguably, if the market was going to work efficiently, maybe those prices should have gone up. But in any case, that was inefficiency. So what does that mean then? If a market is working at equilibrium, it means supply and demand are the same and that they work together. So let's put that into practice then. Let's do an example. A common example, one I actually used in my classes this year, is the market for puppies in the UK in 2020. You may have seen a few headlines about this, in the BBC. I remember reading about this. There's a whole article I remember reading in the BBC about puppy prices in the UK in 2020. And so what happened? Obviously, we had our COVID-19 lockdown. The first lockdown started on the 23rd of March 2020. And what we then saw was that a lot of people realised, maybe being stuck at home, they wanted a little furry partner, a little puppy to keep them company. I know some people I know did that. And it was a very common thing to get a dog for lockdown. Maybe being at home meant you could take that plunge more easily, whatever it was. There was increased demand for puppies. Demand for puppies went up. And so what happened? Let's look at our diagram. What happens if we shift demand for puppies out? Like we say, demand for puppies went up. So let's shift demand out. What happens to that equilibrium that we said before is so important, so efficient? Look what happens. The price of puppies goes up and the quantity of puppies goes up. And so what you saw, maybe breeders started breeding more puppies, maybe people who were on the fence about puppies were selling puppies. Whatever happened, the price of puppies went up and so did the amount of puppies being bought and sold. And like I say, we can see that in the article that the BBC wrote. There were some fantastic diagrams, some fantastic graphs, some fantastic infographics in that article. If I remember, I'll put them in here and show you that the price of puppies skyrocketed in sort of mid to late 2020 because these breeders saw increased demand for their puppies, increased prices for puppies, and so these breeders saw an opportunity to make more money, more profit. Now, the reasons why demand curves and supply curves shift, there's many of them, and I've not got enough time in this video to go through them all, but what I will do, I'll do a video specifically about demand curves and supply curves and what shifts them, and I'll go through examples in a future video. But the takeaway from this video, supply and demand diagrams, once you kind of understand what they mean, supply curves showing the firm side of a transaction, and the demand curve showing the consumer side of the transaction, they're actually quite simple diagrams and they really can be quite useful. When you see something in the news about prices rising or prices falling, quantity increasing, surpluses, shortages, you can really start to understand a lot of what goes around in the world. And that's why supply and demand diagrams are so crucial, so important and so fundamental in economics. So as I say, this is the first video from TJA Economics. I'll be trying to cover a lot of A-level economics and GCSE economics, maybe even IB economics if possible. But what I'd like to know is, what would you like me to do a video on? If there's a particular topic that you want a video on, if there's something I can help out with, revision, lesson plans, whatever it may be, let me know down below. Feel free to subscribe and leave a like, and follow me on my socials, where I'll be posting other updates as well. Thank you for watching.